Hello, this is ERic Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for June 7th of 2021. Please see our disclaimer for important information. Well, as we begin with our high frequency data, I think the message is really clear that the economy continues to improve, expand, to recover. This is our recovery tracker that's produced by our friends at First Trust up in Chicago. And the data really looks pretty good. In particular, and we've got some follow-up charts on this, the open table state of the restaurant industry as well as TSA checkpoint data are looking particularly good. Especially with regard to open table restaurant reservations and things like that. In this chart, it shows change from 2019 only down 5%. Actually, I've got a chart that follows this up, which really almost indicates that we're back to the levels that we had in 2019, which is a remarkable recovery. Now, TSA checkpoint data, we're clearly still below where we were, but there's more flights that are being released into the market. You can kind of see that down below under commercial flights. We continue to see modest increases in inventory into the flight market. And then the supply of motor gasoline, that's also been very strong, particularly over the last month, despite higher fuel prices that were in part prompted by the interruptions caused by the cyber attack on the Colonial Pipeline over in the East Coast. But there are clearly some other impacts into that as well. So if you look at box office receipts, that's probably our most negative number. Not to get too worried there because this data really is dependent on what kind of releases are hitting the theaters. We expect a lot of releases later on this year. We know the consumer interest in spending is exceptionally strong, so we would expect those numbers to look really good, particularly year over year later on this fall. And then retail sales, we know, has been relatively strong. The consumer's been very complacent, been very happy. We know incomes are going up. Clearly, not all socioeconomic layers are necessarily benefiting as well as we would like to see, but notwithstanding that, we clearly see some strength across the entire consumer spending spectrum. And then the jobs number this week, we had announced 559,000 jobs in payrolls in May, and that was basically versus about 278 in April and 785,000 in March. So, and the number that came out in Friday morning was not necessarily as strong as people had thought, but overall the job market continues to improve. Labor market is going to take a while to recover. We've got some charts on that as well. But overall, high frequency indicators are positive. Here's a quick chart actually from Statistica. This is data from ChartR. It shows us in the blue where we are in 2021 in terms of the recovery. So obviously we ended 2020 on a relatively decent note. You know, we had holiday travel, and so it was kind of the high point of the post-pandemic era, and we've only begun in 2021 to build upon that. And in fact, we've accelerated to a point now where we're literally about 25% below where we were in 2019, which is a very positive development. And as you can see, the trends here would lend itself to increased mobility during the summer as more people are getting vaccinated. We know that we've got over half the population that has one dose in an arm already, and so that number is apt to continue to improve over the course of the year. Now here's our open table number, and so this is the one that I thought was really telling here because this is a moving 5-day average indicator for the restaurant industry. This is basically reservations through the open table app, and so it's a really good proxy that has been used far and wide by researchers trying to figure out really what the consumer appetites are and what the trends are post-pandemic. And you can see here, this indicator really shows us that we're back to where we were in the pre-pandemic environment. So very positive. It's taken us a while to get here. We've had fits and starts. And clearly there's more momentum to be had because there's a huge choke point in the service industry right now with labor. And we'll talk about that in a second. But, I've been to several restaurants over the last couple of weeks, and in every case when I've quizzed them, they said, well, we would open more tables if we had more staff. And they can't hire enough people to do the job. And so these numbers here in this chart would actually be better, like literally better than 2019 if we had the workers to support it. Here's a quick chart that comes to us from the Federal Reserve beige book. And so this is the number of mentions of two words, strong and weak. And it's a psychological indicator. This is something that a lot of researchers and psychologists really pore over, people that study psychology of economics. And so basically what this tells us is we've had a really strong spike in the use of the word strong in all of these regional surveys. Now, the beige book is a survey of all of the Federal Reserve Board regional districts, and this is a compilation of all the surveys that go out in those particular regions. And so the word strong has really spiked of late. So conditions are very good from these surveys, and conversely, you see the use of the word weak falling to interim lows, which just tells you that there's a lot of confidence, a lot of enthusiasm out there amongst the survey respondents for this very, very important Fed survey. Here's a change in payrolls, and this is kind of a linear chart showing month over month changes in payrolls, and you can see that we had with the dramatic drop that we had during the pandemic, and we had some fairly stark increases thereafter, kind of building off of the low, and things have been a little tougher sledding since. In fact, at the end of the year, we actually had a bit of a retrenching of sorts in payrolls, but that's clearly changed. And as I mentioned, we had a payroll number last month, rather, in May. We added almost 560,000 jobs, and you can still see here by this graphic from the U.S. Labor Department that we're about 7.3 million jobs shy of where we were prior to the pandemic. And this is a quick chart also depicting labor, but in a different light. This comes to us from the Federal Reserve Bank of St. Louis, but this is the change from January of 2020. So again, this is pre-pandemic. You've got the attendant drop there when everything was shut down. You can see here that we've got the younger age cohorts that have recovered much more nicely. The labor force is sticky. We're about 2 million shy in the total labor force of where we were in terms of employees aged 25 to 54. Overall, we've got a much larger deficit there, as you can see, but the younger and the more mobile have been able to do a little bit better in this environment. Here's aggregate earnings. So we would talk about the jobs and job creation and some of these choke points, but what's interesting here from this chart from Indeed is it shows us that wages and salaries have recovered a lot faster. Now, this is notwithstanding changes legislatively on minimum wages or anything like that. This is just kind of an overall snapshot that in this recovery environment that we've seen, we've actually had a fairly decent acceleration in wages and salaries, and this has outpaced the actual number of jobs being created. And so again, the interesting thing is in the lower unskilled and semi-skilled environments that there's a lot of people that are looking for jobs. Job openings are really, really high, but they can't hire people in that area. But if you look across a much broader spectrum, you can see here clearly that wages and salaries are moving higher than the amount of job creation in the market. Here's a quick snapshot of the U.S. and some of these, I'll call it the retirement of these unemployment, these extraordinary employment benefits. Now, this is, up to the states And so this has been cited as a major reason why in the unskilled and semi-skilled areas where people are having trouble finding people. I mentioned the open table numbers would be better if people could hire more busboys and more dishwashers and things like that. And some of it does have to do with the fact that people are receiving these supplementary unemployment benefits. But it also has to do with other things, and an obvious one that you can look at is in child care, and you look at the rate of displacement in workers, female workers relative to male workers, relative to the pre-pandemic era, and you clearly see the impact of child care on people not able to access the workforce as rapidly as they would want to. But clearly providing people a paycheck, which basically incentivizes them to not want to look for a job, is at play here. But you can see in this chart that there's a lot of states that are transitioning that away. So a lot of states are ending their supplementary benefits this month, including Texas. Some, like Arizona, are looking at July, Tennessee looking at July, Maryland looking at July. And then obviously there are a lot of states that haven't made a call on this yet, but you can see that there's this groundswell of interest to end these benefits to try to help motivate people to get back into the workforce where there are clearly jobs available. Now, with the latest data, again, as I mentioned, the unemployment data as reported by the Department of Labor was maybe a little bit less than expected. But there's another indicator that comes out of ADP, which is a professional employment organization. And so they have a private payrolls index that came out basically earlier, about midweek last week, and it usually precedes the government number that gets reported in the press, and that number was actually pretty strong. So private payrolls, small business formation has really been strong, and I think when you get down into the details here, there's a lot of small businesses that are beginning to form and beginning to grow. And so what that ADP number did in this chart and the two that will follow this is really begin to show a kind of a tectonic shift. So the feeling here as you're looking at the 5-year government bond yield is that we're going to have labor wage pressure that's going to help drive inflation up. And as a consequence, it's driving yields up. So this is an interesting development. Of course, you see here on this chart that these numbers have been all over the page. Yields have moved up and down, for the last month and a half. But they got a real kick in the pants here with that ADP number. And also here is you assume that if you assume that interest rates are moving higher because there's an inflation push, then that would also strengthen the dollar. And we've clearly seen that here over the last several days. And here's the price of gold. So with inflation moving higher, but yields moving higher too, it tends to take a little bit of steam off gold. And it is going to be interesting because gold as a quote unquote inflation hedge has really been kind of called into some question over the last several years, and it'll be interesting to see with the advent of Bitcoin and some of these other what I might call challengers of sorts, to see how gold is going to react. But clearly on the stronger ADP payroll number and the reasonably strong government number on Friday, that clearly gold is taking a little bit on the chin. Now here's long run inflation. Now again, I don't want to get all carried away with inflation because I'm still of the opinion that a lot of the inflation that we have seen is transitory. Now you hear that in the press, and I do believe it. I've got a chart on lumber that kind of highlights that point, that we've seen a spike because of supply constraints and choke points and supply chain problems of actually getting product to market where that's driven inflation higher. So next year, as you see that blue line, I mean, the expectation through this University of Michigan survey is that we're going to have a fairly strong spike in inflation. I don't doubt that. Here in this survey, it's about 4.5%. But if you look over the next 5 years, I think the expectation is kind of anchored around 3%. And I think that's reasonable. Now, if you go back to, I'll call it 1926, the average annual inflation is about 3%. The thing is, over the last 20 years, we've enjoyed something that's been significantly below that. We have not seen inflation, despite all these things that have transpired, asset purchases, quantitative easing. It just hasn't manifested into inflation. Now, I think, in an expanding economy, if you tell me that you're going to have 3% inflation, I'm okay with that. That's very symptomatic with a growing economy. But what the takeaway from this chart is that what happens next year in terms of expectations build, and this is what's driving the interest rate market right now, is disassociated with what happens over the next 5 years. Long-term inflation expectations are clearly different from this kind of unexpected and unanticipated inflation that we're seeing right now. Here's some manufacturing data, and then we've got some service data that follows this. So ISM, Institute for Supply Management, Manufacturing Purchasing Managers Index, really strong. We've been talking about the strength of manufacturing a long time. New orders are at an interim peak if you look over many, many years, and they're holding fairly strong. So this is very symptomatic of a growing, expanding economy. We like to see this. This is a diffusion index, which means anything over 50 represents expansion, and here, anything frankly over 60% represents a really strong environment. Here's our ISM services number. Again, this is the same Institute for Supply Management, but it's a service side, and this is more important because it represents a much greater part of our economy. Again, same story. You can see the ISM services number on the left, above 60, representative of a very strong environment. On the right-hand side, you see the contributions of that. And I thought it was important to put this in here because new orders has a strong influence on this. In business activity, a strong influence. Ironically, employment, not so much, but we have supplier deliveries. And so we've got a lot of the elements of the economy working in tandem to help drive the services PMI a lot higher. Well, we've got a lot of data on this chart, so let's just kind of hit it. And I'll tell you that this is very kind of consistent with what we've been talking about over the last several, I'll call it several weeks to maybe a month or two here. There's no change, right? I mean, we've got inventory sentiment, we've got supply chain choke points. Those are just going to have to work themselves out. So sentiment is down on inventory build. Prices are high. That's the lower left. And that's just a function of supply and demand and getting product to market. And we're seeing that in prices. On the upper left-hand side, we got a backlog of orders. So this is, in a lot of cases where if producers had components in mass, if they had semiconductors in mass, they'd be able to literally produce more. We see this in the automotive market clearly. And then on the lower right, I put this in for good measure, but it's record delays that we're seeing by U.S. manufacturers. And you've got to go back. This particular data point from the Institute for Supply Management goes back to 1987. We haven't seen a reading this high. I mean, we're at 90 days, and that's really an amazing development here. So if we transition and kind of listen to what CEOs are telling us, and we just had a rash of earnings reports, not too long ago. We're going to get a rash of earnings reports for the second quarter in about another 5 weeks, and starting in about another 5 weeks. And right here we can see from the U.S. Conference Board, this is a survey of CEO sentiment and how they feel about the economy. These are executives that have their finger on the pulse of their business, and they know what's going through their profit and loss statement. They know what's going through their order book. They know what their downstream salespeople are telling them, and they're very optimistic. That red line shows you that expectation is really strong. And now the other thing that's important about this chart is the high degree of correlation between what CEOs feel, right, what their sentiment is, which is very positive right now, and the relationship of that to non-residential fixed investment. So this is not just spending. This is actually fixed investment in plant, property, and equipment. This is investment in computers and technology. It's investment in a lot of things. And so there's a high degree of correlation between how CEOs feel and what they're spending money on. And so this is a really, I think, uplifting indicator from the standpoint that it builds in that increased expectation of fixed investment, which is good for the economy. These are long-term assets that derive a return on investment. This is, frankly, what I wish we do more of at the federal level. Instead of just spending money to inject it into the economy, but actually invest it and make investments in infrastructure and things like that have a long-term payback. Clearly, the corporate sector has taken that nod, and we expect to see that capital spending move higher in the months and quarters ahead. Well, here's lumber. I told you that I'd show you something where it might bear some evidence that the inflation that we saw a little bit earlier may be transitory. So we're clearly off the highs on lumber. Lumber's above where it was, and if you talk to any builders, and I know several, that lumber is still a choke point for them, and costs of construction are higher, labor costs are higher. There's just a lot of things. Obviously we don't have a chart here for it, but some of the industrial and heavier metals like copper are still high. So we're dealing with that, but at least they're off their peaks right now. Well, transitioning now to the S&P 500, you can see this lazy trend with some mild pullback activity. If you go back, basically through the end of last year, obviously we've had a very nice environment. We've tested that 50-day moving average a few times, and it's held fairly well. And so we've seen a little bit more turbulence in the last month than we did necessarily in April. And so I don't worry about the long-term health of the market. I do pay attention to some of these indicators and watch where we're hitting below our moving averages. And so again, the 50-day moving average and the 200-day moving average are really important in looking at kind of the technical health of the market. Right now, technical health of the market is actually pretty good. Well, here's a couple of charts here. So this shows you that on the left-hand side, a little bit of a noise here, but it plots the technology stocks. This is the XLK, which is a technology ETF, the technology spider ETF. And that's plotted against the long-term ETF, or basically the ETF exchange traded fund for long-term treasuries. And that number has been, those two have been really highly correlated. So as interest rates move higher and values move lower, that tends to support this notion that technology is going to suffer a little bit. We've seen some outflows, and that's represented on the right-hand side, that outflows from tech funds have actually been very strong as of late, surprisingly strong. And I think the relationship on the left-hand side is important to keep in mind, because the FANG stocks were so instrumental in that recovery mid-year last year in 2020. Now, again, less so now because we're in the cyclical recovery, and we've seen different areas take the lead. We've seen value stocks take a bit of a lead, and these are companies that are cyclically, or I should say, are exposed to cyclical recoveries, which is what we're in now. Last year, it was just all about technology, 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 and you can see here as interest rates move higher, then we can very much expect a regime change there. So I thought this chart was really interesting, and it plots the rally off the March 2020 low against average rally off of troughs in these other recessionary environments, and even not just recessionary, but bear markets. And so you can see here clearly in this red line that we've taken off at a faster rate, kind of an exit launch speed here, that has outpaced some of the average of these other incidences. And so if you look at that black line, you can see where there was a rate of gain, again, less than what we're seeing right now, but even still, we saw a bit of a pause as we got into this particular period in the age of this recovery. And so I think that tells us, history is a guide, but it's not an absolute, of course. But I think this tells us that, maybe we should be paying attention a little bit more to some volatility in the market. Again, it's not unhealthy. It's very much expected. We've gone, ironically, a little while here now without a 5% correction, which is frankly pretty rare. This is one of those things you look at and you remind yourself that, all right, things don't go up forever. Maybe we should just kind of, at least be cognizant of the fact that, that we could have a pause here a bit. Here's another chart that it looks very statisticky, but if that's even a word, but it plots the core inflation rate, as noted here by the year-over-year consumer price index, against the U.S. 10-year yield. And so where we are now is very interesting because the line or the curve of best fit here is reasonably well defined. I'd say that the correlation here is maybe a 0.65 or maybe 0.7. So there's a positive relationship, but it's not overly strong. But you can see that dot marked current, and so we're sitting at about a 3% core consumer price index or core inflation level year over year. However, our 10-year yield remains really, really low, and so that tells you that this bond market is not expecting the inflation that we've seen here lately to be anything more than transitory. And so I spend a lot of time preaching about how the bond market does a really good job of as a predictor of future investment outcomes than does the equity market. And this one, I think, clearly tells us that that the market's not expecting that long-term spike in inflation. Although I'm still pretty firm of the belief that inflation, even if it's transitory, even if there's a lot of it transitory, I think we'll still wind up settling out at a point that's a little bit higher than the inflation rates that we've experienced over the last decade. All right, so on this one, it's really interesting because this is a true changing of the guard. I don't want to overstate this, but it's pretty interesting. So we've had, in the light blue line, we've had a consistent and secular decline in foreign holdings of treasuries as a percent of the total treasury market. This is, a function of a lot of different things, some disintermediation activity on the part of key trading partners like China that is looking to establish its own, hegemony, I guess, of sorts with the yuan. But so they've clearly been net sellers of U.S. Treasuries. Where at the same time, in that dark blue line, we've had a dramatic increase in stimulus. We've had a dramatic increase in the Fed's own balance sheet as an owner of Treasury issues. And interestingly enough, here just lately, we had an inflection point where the amount of treasuries that are owned by our Federal Reserve actually eclipsed foreign holdings, and that's a really monumental event, in my opinion. And the last two charts are really more for general interest. This one caught my eye in the reading this week. And I guess I can attribute it to, there wasn't an article that accompanied this. This is just a chart that was sitting standalone. But you can come up with notions on why this is the case, where murder rates have gone up precipitously in 2020 and 2021. People are displaced from jobs and things like that, social unrest. But this just represents 3 cities in a microcosm. But it is really interesting, and so we have seen a flight, and tying this back to the real estate market, a flight from the inner city, from the urban core into the suburban environments. We've seen that not only for the residential side, but also from the commercial side too. And I don't know where this is going to go in this chart. These increases in 2021 on a relative basis are actually pretty stark. So it certainly bear watching. In our last chart today, we want to talk about the generational wealth gap, and clearly in that line that's declining, that's that silent generation, and those are the older folks that were basically born at or before the end of World War II. And obviously those folks are getting older, they're dying off, so the net ownership of household or distribution of household wealth that is represented by that age cohort is going down at a meaningful clip, and that's being replaced by the younger generation. So you can see the baby boomer generation, which is essentially 1946 to 1964, beginning to level off here. We've seen, as they hit their peak earning years, they were accumulating a lot of wealth. Now they're in a spending phase, if you will. So their share is going down. Well, at the same time, the Gen Xers are basically 1965 to 1980. They're hitting their stride. They're hitting their peak earnings capability. And we know from the consumer savings data that consumer balance sheets are strong and people are saving money. So Gen Xers are really driving the boat right now in terms of net savings, of household wealth generation, and so on and so forth. Whereas millennials, those are folks that are basically 1981 to 1996. They're getting into their own right now. They're out of school. A lot of them have school loans and things like that, and they're upwardly mobile. So they're on the map now. And obviously, as the silent generation rolls over and they become less influential in this chart, you clearly will see the Gen Xers take the hold that the baby boomers did a generation ago. And you'll see the millennials rise as well. And eventually you'll see those Gen Zs begin to populate this chart. But I found this really interesting to see how the net worth of this country from a household perspective is being, how we're witnessing a changing of the guard literally before our eyes. Well, that will certainly do it for this week. Hope you've enjoyed this episode of Charts of the Week. In behalf of all my colleagues at BKA Wealth, we appreciate you. Hope you have a safe week, productive week, and we look forward to seeing you again very soon. Take care.